Hey, welcome back. It's Jason Walter here. In today's video, I'll share the latest housing market update with you, and stick to the end of this video because I have some economic news to share as well. Lots to cover in today's housing market update, so if you get any value whatsoever, then please hit the like button. I greatly appreciate that. Videos like these tend to take hours to make, so I greatly appreciate your support. Also, please consider subscribing as well because I post how this pandemic is affecting our housing market. So thanks so much for doing that. Let's go ahead and dive right into the video. The MBA posted yesterday that the total number of mortgage applications decreased 6.9% from 1 week ago. And as the Mortgage News Daily reported, this is the lowest mortgage volume in 18 months. So at first glance, this sounds very bad, right? A decrease of 6.9% in one single week for mortgage applications in the US. But let's dive deeper into why this actually happened, because this is total mortgage applications, which include refis and home purchase applications. And the MBA breaks this down by indexes. So the Refinance Index decreased 8% from the previous week, whereas the seasonally adjusted Purchase Index fell by 5%. We all know that mortgage applications for refis are tied directly to mortgage interest rates and not necessarily the demand for housing from home buyers. So instead, let's have a look at applications for home purchases instead. The MBA's senior vice president and chief economist stated the following: purchase applications for conventional loans declined last week to the lowest level since last May. The average loan size for total purchase applications increased, indicating that first-time homebuyers, who typically get smaller loans, are likely getting squeezed out of this market due to the lack of entry-level houses for sale. The most recent stats that I can share with you for first-time homebuyer purchases is compliments from the National Association of Realtors for May. And so far, there has not been a significant decrease of first-time homebuyer sales. So let me explain. So NAR reported that first-time homebuyers were responsible for 31% of all sales in May, which was equal to the percentage in April, but down slightly from 34% in May 2020. However, he's absolutely correct that we have a severe shortage of houses for sale at the entry level. And we can see this when we look at May home sales. As you can see here, sales of houses of less than $250,000 decreased from 1 year ago. In stark contrast, sales of houses over $1 million skyrocketed 244%. In other housing market news, our extreme shortage of houses for sale may be starting to improve as more listings hit the market this June. This is based on an update from Realtor.com that was posted yesterday. So they announced that in June, newly listed houses grew by 5.5% on a year-over-year basis and by 10.9% on a month-over-month basis. However, when compared to the years 2017 to 2019, newly listed homes this June are still down 14.4%. Despite the recent increase of new listings, overall inventory in the US is still historically low, but the rate of decline has been slowing. On a national level, housing inventory in June decreased by 43% over the past year, but that was at a lower rate of decline compared to the 51% drop in May. If you want to see a depiction of the lack of houses available for sale, then check this out. Another word, by the way, for active listings is housing inventory, which is the number of houses listed for sale at a specific moment in time. At the bottom of this graphic is this yellow line, which represents the total number of active listings in 2021. So check out how incredibly low that is compared to prior years. So in January 2017 to 2020, the number of listings was around 1 million to 1.25 million houses. Compare that to January of this year, and there were only 600,000 houses available for sale. So in June, it's even a larger difference. There's less than 600,000 homes for sale in June this year versus the 1.3 million in 2017 to 2019. The number of houses for sale, of course, varies by the area, of course, so every market is different, right? So for example, the cities that are experiencing the highest growth are Milwaukee, San Jose, and Cleveland. Markets that are seeing the biggest decline of newly listed houses are in the southern metros such as Nashville, Raleigh, and Miami. Part of the reason why housing inventory is so low is, of course, that new listings are not hitting the market very fast. In addition, houses are selling very quickly as well. According to Realtor.com, the typical home sold in 37 days in June, which is 35 days faster than last year. It's also 21 days faster than the typical time on the market during the June 2017 to June 2019 time period. The best way to show you this is to have a look at this graphic. So again, the yellow line represents 2021. So the days on the market in January wasn't too much less compared with prior years, but it has fallen sharply ever since then. So except for 2020, which of course was an anomaly, in prior years, the time on the market started to decelerate greatly in March, but not this year. In 2021, it continued to drop drastically through June. Now the average days on the market is about 20 days less than prior years. In addition, among the largest US metros, none of them had an increase of days on the market compared to June of last year. I also have an update for you regarding home prices. This is because list price growth has started to moderate, which is good news for home buyers. June's list price growth rate was 12.7%, and that was lower than May's growth rate of 15%, so it started to slow down here. This is now the second month in a row when the annual growth rate has decreased. This is a positive sign because we're slowly starting to move in the right direction of a more balanced real estate market. It goes to show that home prices cannot increase indefinitely. On a national level, the unsold inventory for existing houses sits on a 2.5 month supply. What this means is that all houses listed for sale would be sold in 2.5 months at the current sales pace. Surprisingly, for brand new houses, the month supply is almost double that. It's 5.1 months, according to the US Census Bureau. However, I would give you a word of caution regarding this because one would assume that 5 months means it's a balanced real estate market, and that's not really the case here. This is because the US Census Bureau counts units authorized but not yet started as technically for sale. So let me briefly explain because I'm seeing a lot of confusion on the internet regarding this. But the US Census Bureau reports houses that are authorized but not yet started, but builders right now are basically getting permits pulled but not starting construction. So they're not technically for sale, even though the US Census Bureau does count them as for sale. And that would inflate the month supply. I know that can be a little bit confusing, so if you have any questions, then please leave me a comment below. But let's go back to this report from Realtor.com and discuss home prices across different regions in the US. Among the largest 50 metros, listing prices are increasing the most in the large Western markets, where they're growing at a current average pace of 10.8% over last year, compared to a growth rate of 7.2% for Southern metros, 4.1% for Northeastern metros, and a small 2.9% decline in the Midwestern metros. In addition, Austin, Texas, Riverside, California, and Tampa, Florida posted the highest year-over-year median list price growth in June. To give you a quick mortgage interest rate update, Freddie Mac actually released the results of their weekly survey this week, which showed that the average 30-year fixed-rate mortgage dipped to 2.98%. The average 15-year fixed-rate mortgage dropped to 2.26% from the previous week. In other news, lumber commodity prices continue to absolutely crater. The last time lumber was this low was in January of this year. And lastly, the US jobs report for June was posted today. They reported that 850,000 jobs were added versus an expected 706,000. However, the unemployment rate unexpectedly rose to 5.9% versus the 5.6% estimate. Before this pandemic begun, the unemployment rate was around 3.5%. In contrast, the real unemployment rate, which accounts for discouraged workers and those who work part-time for economic reasons, fell sharply to 9.8%, putting the so-called real unemployment rate below 10% for the first time since March 2020. Seema Shah, who's a chief strategist at Principal Global Investors, stated the following: From a market perspective, this was an all-out positive jobs report. The improvement today likely reflects a slight easing of the labor supply constraints that have been holding back the jobs market in the recent months, as well as continued momentum from the economic reopening. However, the total employment rate remains 7.1 million below where it was in February 2020. If you enjoyed watching this video and if you got any value out of this video, then please hit the like button. I greatly appreciate that. And also consider subscribing as well. You also can follow me on Instagram. I'm Sacramento Realtor. Hope you have a great holiday weekend and look forward to seeing you on the next video.